Hello and welcome to the Dorsey Wright podcast for the week ending on May 27th. My name is Ian Saunders, and joining us here as well today is Will Gibson. Will, it's good to have us back in the office here. I know we've taken a week or so off from this podcast. We were out of town last week at the NDW Spring Symposium out west, out in Las Vegas. So hopefully some of you listening in were some of those people that we had the opportunity to meet out there. Hopefully you had a good time at the symposium. I know that we did. It was good to finally see people face to face again. It's been a long time, 2.5 years since we were able to do one of those in person.
Yeah, seriously. No, it was a great time to be out there, see people that we get to talk to over the phone and email in person. It was a great event, and taking a break from media for a week, we were prepping for the podcast and we're like, wow, we haven't talked about this stuff on the podcast or in our weekly rundown for 2 weeks now. So I know we got a stack of stuff that we'd like to at least give some updates on and our thoughts.
Yeah, absolutely. I mean, like Will said, we might have been a not quite as opportune time to take a couple of weeks off or take a week or so off from doing the podcast there. But there has been a lot of market movement that has gone on over the course of the past couple of weeks. I mean, we're starting broad, right? Starting looking at that major asset class picture. You see a picture that hasn't changed a ton, but really kind of seen the story more the same over the past couple of weeks, just more amplified movement, really. I mean, starting with commodities, we've seen commodities kind of maintain a lot of resiliency, holding on to that top spot in the Dolly rankings. You look at the commodity groups, or some of the only groups scoring above that 4.0 score threshold on the asset class group scores page. Domestic equities on the other side of the coin, not doing too hot over the past couple of weeks. For looking at that longer term kind of time horizon in the Dolly rankings, we've seen the domestic equities asset class lose 55 buy signals over the course of just since May 6th. Looking here, dropping to a buy signal tally count of 199 buy signals. So pretty distant from commodities, up there at 316. Domestic equities getting kind of closer to those lower ranked areas there in the rankings, but we still see it holding on to that second position at this point in time. And I think a lot of the movement that we've seen, a lot of the commentary that we've seen over the course of the past couple of weeks, I mean, you've seen this major sell-off. You're seeing a lot of indicators getting into washout territory, which we'll get into here more in just a sec. And you're seeing some of the things start to tick a bit higher. So when you're looking at the relative strength side of the coin, that stuff tends to be a little bit more slower moving, a bigger picture, longer term view. And we've still seen a degrading of buy signals from the broader domestic equity space. Looking at some of the near to intermediate term view, you're seeing things start to at least try to swing a little bit higher. At the time of this recording, on when we're recording the podcast here on Thursday afternoon on May 26th, we're seeing the NASDAQ up over 2.5%, the S&P up over 2%. And we're seeing the past couple of days of market movement show a little bit of push to the upside, pretty notable push to the upside for the S&P. I mean, coming into this week, Will, I know that you and I were talking, we've seen 7 consecutive down weeks for the S&P 500. It's been pretty notable, and it looks like we're about to break that trend with some of the movement, at least that we've seen over the course of the past week.
Yeah, we would certainly hope so on that front. It's been brutal beneath the surface too, because if you look at the S&P, you've been like flirting with bear market territory for a while here. But if you look beneath the surface at those individual names, it's been much more uncomfortable probably than the broad indexes are masking. If you look at the individual representatives above their 50-day moving average, or the individual representatives that are on point and vigor buy signals, or any of those participation metrics, those have been at extremely washed out territory for a while now. As you mentioned, we have seen a positive week, and with that positive week, that has affected some of our indicators in a good way. I mean, put bluntly, there's a number of short-term indicators that I'll hit on here in just a moment that have ticked higher. But one kind of comment I'll interject here, but before we get to that, is we like to run a piece, and it's been timely lately, that the best and worst days you tend to see cluster together. So when we were out in Vegas with many of you and many of others, we were seeing some of the worst days for the market, at least year to date, not necessarily historically over the past 20 years or anything. Have some perspective on that, but at least year to date, you've seen some of the worst days. And then at the same time, you've seen some of the best days couple around those worst days, where it's really difficult to sidestep all of those entirely, at least, but kind of using some of these short-term indicators to help us determine that maybe we're in some type of near-term bottoming process where you're seeing some demand follow through is a good sign. And that's probably what we should hit on.
Yeah, certainly. I mean, you look at some of the different performance, like you see in major swings in the market. I mean, especially we've seen that on an intraday perspective too. I mean, you're talking about at the early stages of this decline, things were trying to kind of hold on, and then you'd see things sell up pretty hard later in the day, right? No one wanted to hold stocks going into the weekend. A lot of times, you saw some pretty sharply negative movement on later stages in the week, on Thursdays and Fridays, and that picture shifted a little bit, at least over the course of the past week. We ran a piece in the Daily Report earlier this week that was looking at just the percentage of trading days so far this year that the S&P 500 has seen a low to close rally of at least 1%. So a positive move from the low for the day to the close, not necessarily ending positive, but at least bouncing significantly off of that low. We've seen at the point when we wrote this article, 39 days of market action through trading on Monday that saw that action occur. I believe we're now at 41 days with movement over the last couple of days, but roughly about 40% of the trading days so far this year have seen the S&P move from a low to close at least 1% intraday. The only other years going back to 1987 that we've seen that magnitude or that's many days, looking at 2008 and 2009 as the only other times. And there's been a lot of comparisons to 2008, 2009 environments over the course of the past couple of weeks. Not saying that this environment is going to be 2008, going to be 2009. Every market environment's different, and this one is certainly has its own unique stance to it. But it's pretty interesting to note that this volatility, I mean, we're reaching some pretty unprecedented levels in terms of intraday swings, intraday movement higher. But it is a good sign to see this intraday swings higher, at least show some demands coming back into the picture, right? We're showing that people are at least willing to hold on to stocks for maybe over the weekend. Like we saw I think the last 15 minutes of trading on Friday was when you saw that massive 1% move to end muted or just slightly positive on the day. That people are looking to hold on to stocks for maybe a little bit longer than they had previously, and that's leading to some of the indicator changes that we've seen. I know that we've been one of the most frequently monitored near-term indicators is that NYSE high-low indicator, which, just for those listening as a refresher, just measures the percentage of stocks in the New York Stock Exchange making a new 52-week high relative to those making a new 52-week high or low. So basically, stocks making a new high relative to stocks making any extreme. Ideally, you'd like to see that number moving higher in a bullish market environment. This indicator tends to move at pretty extreme levels. So, I mean, it got down all the way down to the 6% level with movement throughout the month of May, which is pretty low. Movement below 10% tends to be pretty low. And then with movement over the past week, we've seen it reverse back up to a chart level of 12% there, which I know, Will, we were talking about from a forward return perspective, or just in looking at how the market typically does. I mean, reversals up from beneath 10% generally tend to be pretty good, right?
Yeah. I mean, you're looking 1 month out for the S&P 500. After that high low goes below 10%, it's about 2%. After that, 3 months out are about 4%, 6 months, 8%, and then 1 year out was an average return of about 18% coming out once that high low goes below 10%, which we had happen here. So there's probably a lot of mean reversion going on there. And then in many instances, a building of some type of new uptrend. So it is helpful to see when you get to washed out territory and then you finally get that reversal back up, which is what's happening through close yesterday. You got that reversal back up into X's. That's been a good sign for us, at least on the short-term front. Some other shorter-term indicators that I'll mention as well are one of them is the 10-week for the New York Stock Exchange. So a bit different than that high low. The 10-week is measuring the percentage of stocks trading above their 50-day moving average. And that reversed back up into X's yesterday as well. So the same day as the high low, that is coming out of chart territory of about 20%. So not as extreme as the high low reading, but it's still a positive. That actually put in a higher bottom. So prior to that, you were at 14% on the 10-week. You bottomed at 20%, and now we're moving higher. So that's another good sign. Both of those short-term indicators are in X's. They're kind of moving up that pole. You saw the bullish percent for the New York Stock Exchange. That actually went into X's earlier, so before the 10-week and the high-low. So all three of those are in a column with X's right now, coming out of low field position, which is a pretty constructive and promising sign, at least for the near term and from a technical front.
Yeah, certainly. I mean, it's interesting too. I mean, we talk about the near term, the intermediate term, the long term, right? I mean, the high low and the 10-week tend to be more kind of near term focus indicators. Your bullish percent, we generally tend to think of as more intermediate term indicators. And like you said, we did see that swing higher before the near term stuff did. And just to conceptualize that, I mean, the high low and the 10-week are looking at moving averages, right? So we're stuff like the BPs, maybe in this choppy market environment, you're getting a lot of volatility. It might be quicker, something to pop back and go to a buy signal. And it might be to kind of undo that moving average deal, which I think is an important thing for people to keep in mind. But nonetheless, seeing them reverse higher in conjunction with one another is what we want to be looking for. But it's important to keep in mind that, like we said, I mean, we've gotten this chop back and forth. We've seen, like you said, some of the most sharply negative down days paired with the sharply negative up days that leads to some back and forth movement on charts, which leads to changes from an indicator perspective. But I mean, it's important to keep in mind that just because something is moving higher, I mean, we like to see kind of further confirmation before really cementing a move. I mean, you look at like the high-low index. I mean, it has worked out most of the time that we've seen reversals up from below 10%, but not every time. I mean, you look at 2018, we saw it swing lower in October, get down to 6%, go higher in November, go back up to 34%, and then all of a sudden fall all the way back down to 2% by the end of December of 2018. So, I mean, it's just an important thing to keep in mind. We're looking at these for historical context to help provide some perspective, but where we can see things potentially move. But just seeing things push higher, we are still waiting for that kind of further confirmation on the longer term point of view. But nonetheless, I mean, we were talking before, there are certainly opportunities, areas you can look toward. That doesn't mean just because we haven't seen some of the longer term stuff swing higher, that doesn't mean you can't do anything at the current moment, right? I mean, we've seen a lot of changes in leadership. We've seen new sectors coming into the fold, and that sector strength has really kind of been continued throughout this downturn. So I think, as we were saying, I mean, focusing on those areas of strength, those stronger RS areas, those high ranked sectors, high ranked styles, I mean, are potential places that you could kind of look towards as we to see if this kind of this balance is something that can be sustained.
Yeah. And one thing I want to go back on in just a second about some of the volatility that you said with the market, but also with the indicator wise, getting to these washed out territories, you typically you see some type of indicator volatility as well at those levels. It's not just market volatility, but you actually see some indicator volatility. So with whether it's the bullish percent or the high low or the 10-week, it's not common to see this elevator move, like where you go to heavily washed out and then straight back up. That happened in 2020, and that happened somewhat at the end of 2018 as well. But the historical precedent is actually to see some chop in those indicators before you eventually resolve higher. So if you're looking at these and you're seeing a multitude of these reverse up, yes, that's a good sign. And yes, historically, that has been a good buying opportunity. But keep in mind that volatilities, we see it typically remain high around these levels. And that doesn't mean there may not be another opportunity to come back in. It doesn't mean that right now is a bad opportunity, but you may get another one. Now, Ian, and to kind of what you were just saying about the leadership coming out of you're using some of these indicators to identify that, is that you've seen a lot of bullish percents and participation readings across the board for all sectors, whether strong or weak sector get to washed out territory. So maybe looking at some of the longer term readings to say, okay, where's the trend for us? Like, where is their favorable relative strength? Those sectors we're still going to want to be focusing on and maybe building our allocation there. It's not something that says, oh, just because XYZ sector is washed out, I'm going to go load up on it now. In some instances, those bullish percents coming out of washed out territory could be assigned to maybe trim out of some of those laggard areas, sell into rallies, and then kind of further orient your portfolio towards those strong sectors.
Yeah. I think that's an important definitely an important thing to keep in mind. I mean, we're seeing, the technology sector is something that everybody's talking about, right? I mean, a lot of these names have been beat up much worse than most of the other broader market. And looking, I mean, you cover up the names, you look at some of these charts. I mean, they're not the same charts that we saw in the 2020 decline. They're not the same charts that we saw in the 2018 decline. Technology is not holding on to the same technical ranking that we saw at a lot of those times either. And so I think that's an important thing to keep in mind. It's not the time to be covering up your eyes and just throwing darts at a wall of tech stocks, right?
Yeah.
Or consumer discretionary, some of these areas that have been beaten up pretty bad. Now, their time certainly may come back, but at least using the indicators, using the readings for what we have currently, the time's not right now. Right. And so I think, like you said, I mean, if you're holding on to some of these names, hoping it's going to bounce, you might get a bounce, and that might be a better opportunity to reorient the portfolio towards those current those current momentum, those current leaders in the marketplace. I mean, in looking at some of the other broader picture, broader market movement, that idea of kind of confirmation is something that we've continued to plan at things. We started things off looking at that broader relative strength dolly tool. We still see domestic equities over the past couple of days, over the past week, continue to lose buy signals from that broader relative strength perspective, while we're starting to see some of these near-term stuff swing higher. I mean, so you would ideally like to see some of those buy signals at least stop losing buy signals, right? From the longer term perspective with some of these near-term movement going higher. And we'll probably see that with some of the strong upwards moves. Some other indicators and stuff. I mean, we focused on the high low, some of the near term. We focused on the bullish percent, some of the more intermediate term. Personally, one that I like to continue to monitor is the looking at some of the positive trend, the PT charts. I mean, that percent positive trend for the S&P 500 is something that's frequently referenced about the 50% threshold, right? So you'd ideally, I mean, it's simply taking a measure, the percentage of stocks in the S&P 500 trading in a positive trend. Right now we're at 34%. Most of the gains, the broader market improvement for the S&P comes when that indicator is above 50. And so seeing it cross beneath 50 is definitely indicative of a poor market environment. But another thing to kind of keep an eye out for, even though we're pretty far away from 50, is looking at those reversal points. I mean, we saw in 2020, we reversed up right at the beginning of April 2020. In 2019, we reversed up in January of 2019. I mean, you've seen a lot of these. It's not going to be the first thing. It's a more longer term focus. It takes more work to move back to a positive trend than it will to move back to a buy signal. But I think monitoring that too, we haven't seen that start to tick higher yet. That's something, at least personally, that I'm kind of keeping an eye out for, and at least setting an alert on to make sure if we do see this kind of confirmed and continue to be swinging higher, that's definitely another place to continue to monitor there.
Yeah, that'd be a great kind of next indicator, if you will, after some of the ones that we've already seen roll higher. That would definitely be one next on my list as well, to give me some further confidence, if you will, kind of weight of the evidence. That would add, but most certainly. And then maybe just kind of wrapping out here, broad picture wise, these are all trend following, momentum based indicators. And quite honestly, the environment's actually set itself up to be favorable for a lot of momentum strategies. You look at some of the models and how they have been allocated, some of the indicators, kind of macro indicators as well. They've been positioned for this commodities and honestly kind of defensive sector tilt. So we like that for momentum as a whole, and kind of continuing to see leaders lead and laggers lag is what we would hope for our strategies right now.
Yeah, certainly. I mean, there's no shortage of stuff that we can continue to monitor and follow. I mean, we've thrown out a lot of different charts, thrown out a lot of different indicators. We're trying to talk about as much as possible, given we haven't had the opportunity to talk about it for a couple of weeks here. But as always, if there's any kind of questions on any of these indicators or anything you see, for those that are subscribers, those that are on the following along with us on the site, please do reach out to us. I mean, we're more than welcome to reach out to us there via email at dwa@dorseyright.com or via the phone 804-320-8511. I mean, anyone who's kind of following along, we do understand that this is a difficult market environment, and that's why we hope that we can be here to try to at least help with some of the understanding of what's going on from that price movement, that technical perspective. So. Well, I mean, it's great to be here face to face again, doing this podcast, and thank you everyone for listening and tuning in to us this week. And we look forward to talking to you again next week.